Raoul Pal warns of a possible scenario reminiscent of the years 1998 to 99. In his assessment, it could happen that several major risks are suddenly eliminated from the world, for example, through an agreement between Saudi Arabia, the USA, Israel, and Iran, a ceasefire in Ukraine, or reasonable steps taken by China in global conflicts. And if these cases occur, the dreaded extreme risks would disappear. Then, according to Raoul Pal, investors could still continue to warn about rising inflation even if the data shows that it is falling. And this narrative could persist for 18 months, similar to what happened in the past.
Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine. And let's assume that the Chinese will come to the table and do something reasonable. If those three things happen, we've taken all of the left tail off the table. And people are going to be like, oh, but inflation is going to come back. And they're going to keep saying that for 18 months, just like they kept saying as inflation was falling. So I think there's a not insignificant chance that we have a real blow-off kind of next 9 months or so.
His conclusion, it is not unlikely that the markets will experience a surprisingly strong rally over the next 9 months, a kind of blow-off phase in which fears temporarily fade into the background and optimism drives prices higher. According to Raoul Pal, the world could then be on the verge of a massive market surge. A possible ceasefire in Ukraine, diplomatic progress between the US, Saudi Arabia, and Iran, or China's willingness to cooperate could mitigate key risks for the markets. And even just two of these scenarios combined with falling inflation would eliminate the biggest risks, which, according to Raoul Pal, could trigger an explosive rise in stocks and crypto. A blow-off top driven by narratives, liquidity, and momentum, not by fundamentals, not by fundamental data. And we've seen a new all-time high for Bitcoin. Liquidity has quietly flowed into the system. The mix of skepticism and a quiet flood of money could now lead to a sudden rally once it becomes clear that risks are fading. And then we could see the so-called banana zone described by Raoul Pal. So let's take a quick look now at what Raoul Pal actually said. And if you want to achieve financial freedom through crypto, click the link in the description below the video. Watch the video, it's free and only available for a short time. Raoul Pal explains that cryptocurrencies are often misunderstood. They are not an isolated phenomenon, but rather a macroeconomic asset class influenced by the same factors as traditional markets: liquidity, economic cycles, and sentiment. And for years, Raoul Pal has been observing how Bitcoin and other cryptocurrencies react to global money flows, often more extreme in their movements but fundamentally predictable. And right now, everything points to a strong upward phase. The global money supply M2, a key indicator for liquidity, has stabilized and is now rising sharply again. And historically, this has signaled rallies in risk assets like Bitcoin, whose price movement is currently almost parallel to this trend. At the same time, according to Raoul Pal, sentiment in tech stocks and crypto markets is extremely pessimistic despite rising prices. And that's a classic buy signal, since many investors missed the recovery. Raoul Pal compares the situation to the Asian crisis of 1997. Back then, a brief but intense shock phase led to a V-shaped recovery when central banks pumped liquidity into the system. And he sees something similar happening today.
So, what I've done is build that framework of how crypto is just a macro asset. And it took a long time for people to believe that. They thought it was something different, something unique. It's just a macro asset. So you apply the same things I've always used: liquidity, business cycle, all that stuff, plus a bit of technical analysis and sentiment. There's no magic here. It's actually pretty straightforward as an asset. It's just more volatile, so it's harder to handle. But you were right. What I was seeing was that the liquidity indicators like global M2 had stabilized and started to rise. It leads Bitcoin. Bitcoin is following it almost perfectly. So I started looking for the bottom. Then I started looking at things like, okay, where is sentiment on the NASDAQ? Because it's a tech stock, same thing. It was in the gutter.
Right.
Sentiment was the worst I had seen since COVID. That was across the board, across everything, even hedge funds, long, short. Everyone was as bearish as possible. And I'm looking at liquidity and it's going up. I'm seeing the market getting fearful over a narrative. And I'm thinking, well, what is the likely outcome here? Are they really going to have 150%, 1 trillion% tariffs on China? No, they're going to reach something normal. So you've gone from peak headline fear to a situation where things can only get better from here. So for me, it was a no-brainer opportunity, both in tech stocks and in crypto. And so looking ahead now, normally this is the period. My framework is about them rolling over the debt and having to provide liquidity to do so. And so what we have is a lot of forward-looking liquidity coming in, whether it's from the weakness of the dollar or from other countries using their balance sheets or a number of different mechanisms. And all of that, to me, suggests that the rest of this year is going to be very strong. And I was kind of thinking the NASDAQ would have a V-shaped recovery. And my God, it was a V-shaped recovery and people are still underweight and short. I mean, it's a hell of a setup. We overlaid the chart from 1997 when the Asian crisis was a short, sharp shock and compared it to now. It's almost identical. The kind of 4 or 5 month period leading up to it, leading up to the event, was also a V-shaped recovery because everyone was caught off guard, thinking the world was going to end. Then liquidity came into the system. That time it was the Fed cutting rates along with all the other central banks, and the market just went up in a straight line for the next 2 years.
Geopolitical risks, such as conflicts in Ukraine or tensions with China, could ease, which would dispel the market's greatest fears. Even without interest rate cuts by the US Federal Reserve, the mere prospect that monetary tightening is coming to an end is enough to fuel risk assets like tech stocks and crypto. Institutional investors also play a central role here. Sovereign wealth funds from the Middle East have already been investing heavily, attracted by the increasing regulatory clarity in the US. Major banks like Goldman Sachs and JP Morgan are just waiting for the green light to expand their crypto offerings. Raoul Pal sees parallels to the introduction of gold ETFs or commodity indices. Initially met with skepticism, these later became standard in portfolios. Crypto is currently going through the same phase of acceptance, volatile but unstoppable.
There is a risk here that we might repeat 98, 99, or 99 because you've just removed all the tail risk. Let's assume that Saudi Arabia, the US, and Israel make a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine. And let's assume that the Chinese will come to the table and do something reasonable. If those 3 things happen, we've taken all of the left tail risk off the table. And people are going to say, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, just like they kept saying it as inflation was falling. So I think there's a not insignificant chance that we have a really explosive next 9 months or so. The last Trump cycle in 2017 was similar. The market corrected at the beginning because everyone was afraid of tariffs and the same narrative. The Fed was raising rates and running off the balance sheet. And yet the market soared all year because the Chinese were stimulating and the Europeans had to stimulate as well. So it feels like, even if the Fed doesn't do anything, I still think the Fed will cut, but let's assume they don't. Well, that's not a prerequisite for the market to do anything, as you said. As long as rates aren't shooting higher,
yes,
all fine.
While mainstream narratives remain focused on inflation risks and geopolitical instability, Raoul Pal presents a sharply contrasting perspective based on macroeconomic indicators and capital flows. He argues that crypto, often misunderstood as a standalone asset class, is actually deeply connected to the same forces that drive global equity markets: liquidity, sentiment, and the business cycle. When those levers move, crypto reacts, often with greater volatility, but also with greater upside potential. According to Pal, the liquidity environment has already started to shift. Global M2, a broad measure of the money supply, has stabilized and begun to rise. Historically, this has served as a leading indicator for Bitcoin and other risk assets. And once again, Bitcoin's price action seems to be closely tracking that trend. At the same time, sentiment in the tech and equity markets has remained deeply bearish, even as asset prices recover, creating a powerful contrarian setup. Hedge funds, institutional portfolios, and retail traders alike have stayed underexposed, missing out on the rally in both crypto and U.S. equities. The result, according to Pal, is what he calls a no-brainer opportunity. With forward-looking liquidity quietly on the rise, driven by a combination of dollar weakness, central bank interventions overseas, and ongoing debt rollovers, markets are positioned for continued upside. He compares the current environment to the recovery following the Asian financial crisis in 1998 to 1999, when a V-shaped rebound caught investors by surprise, kicking off a 2-year bull run fueled by unexpected central bank easing and improved global coordination. Crucially, Pal stresses that the current rally isn't based on the Federal Reserve cutting rates, even though that would likely provide an additional boost. Instead, it's the lack of further tightening and the fading of macroeconomic fears that are enabling risk assets to reprice sharply higher. From his perspective, we're only in the early stages of a broad restocking of U.S. equities and crypto holdings, a process that could continue well into next year, especially if geopolitical risks subside and inflation concerns keep diminishing.
No, it's real. And I'll tell you why it's real. I've just come back from the Middle East. All of the sovereign wealth funds are now buying, right? These are the largest pools of capital in the world. We're hearing this from Saudi Arabia, from Abu Dhabi, from Qatar, and from Bahrain. And the reason this is happening is because the US has become crypto friendly. It's a green light. So the US will pass some regulations. There will be a bit of a mess and a lot of debate about it, the usual stuff, but they will get some regulation through, and that's the clarity all the pension funds need. So they're waiting too. So there's a lot of buying yet to come from the really big players who have been waiting. For example, Goldman hasn't been able to fully build out its desk, and neither has JP Morgan. They've had crypto for a while, but only for certain types of clients, and they want to build that tailored product. But they've been waiting for regulatory clarity. So yeah, I think it's a big deal. The institutions are still either trying to figure out how or what exactly this thing is, right? I had a conversation yesterday with one of the biggest financial asset management firms in the world, based in the US. And they're like, they even have a crypto division, but in their other departments where they allocate assets, they're saying, we don't know how to handle this. So they're still trying to figure out what it actually is.
Yeah.
Like they haven't realized it's a macro asset. Others have. The sovereign wealth fund is obviously just doing it for diversification of reserves. They're like, it's a technology. It's a diversification of reserves. So if the US is going to do it, we're going to do it too. So there are different groups doing different things. There are still a lot of people who don't really want to do the homework on it. They're like, we don't know. It's too volatile for us. But I think usually there's a first mover advantage in this. And again, it reminds me a lot of back in the day when Goldman rolled out the GSCI index and nobody had commodities in their portfolios. And that team had to go around and sell commodities to everyone. And they would say, the clients would say, but it's too volatile. And you would say, yes, but as part of a diversified portfolio. It's exactly the same thing, right? That's right. And also, we were around when the gold ETF started, and it's the same thing. Everyone was like, holy shit, where did this come from? It became a very, very big ETF. It's exactly the same. What people like to do, because there are so many new participants in the industry, they think it's all new and different. If you've been around as long as you and I have, you realize nothing is different. We've been through all of this before. This just happens to be a bigger, faster moving asset, but it's the same as GSCI was. It's the same as the gold ETF was. It's the same as the NASDAQ was when we didn't understand what it was and why it was going up all the time. And it's all of these things combined, right? What do you think about gold here, Raoul? So I came up with something. It was just last month in Global Macro Investor. That kind of shocked me that I hadn't figured out before, which is that there's a set of dominoes that happens in markets. Financial conditions lead everything. For financial conditions, we use the dollar, rates, and oil, right? Those are the three big financial conditions factors. What we found is that this leads things like the ISM and other stuff by about 9 months, and it leads liquidity by about 6 months, something like that. Liquidity is what drives Bitcoin and the NASDAQ, and it leads them by 3 months. So global M2, let's say, leads Bitcoin by about 3 months. That's what I found out. I was like, what's going on with gold? I compared it to global, to financial conditions. It reacts in real time to financial conditions.
Raoul Pal also analyzes gold. He says the price doesn't react to distant crisis scenarios, but rather responds immediately to financing conditions. If the dollar value drops or monetary policy is loosened, gold rises immediately, a direct signal of currency devaluation. And these patterns showed that all assets ultimately follow macroeconomic rules. So for Raoul Pal, it's clear. The combination of rising liquidity, underinvested institutions, and waning risk aversion creates explosive conditions. This means that the coming months could trigger a rally that will surprise many, similar to 2017, when markets exploded despite interest rate hikes, simply because the big money hadn't entered the game yet. Raoul Pal outlines a possible turning point in the financial markets, a transformation reminiscent of past revolutions, but this time unfolding at a rapid pace. His analysis shows how major capital powers, such as sovereign wealth funds from the Middle East, US pension funds, or large banks are quietly building positions in crypto as well as in Bitcoin and stocks. And the crucial difference compared to the past, It's not the technology that has changed, but the regulation. Clear signals from the US are now giving institutional investors the confidence to enter the market on a large scale. Nevertheless, many asset managers are still hesitant. Some don't understand crypto, others shy away from the volatility or don't know how to integrate it into traditional portfolios. Raoul Pal compares the situation to historic market shifts, such as the introduction of the GSCI Commodity Index or the gold ETF. Each time, initial uncertainty held back the majority while bold pioneers benefited. And his thesis is supported by data. Financial conditions such as the US dollar, oil prices, and interest rates drive macroeconomic trends. This is followed by liquidity surges, which ultimately fuel risk assets like Bitcoin. And interestingly, global liquidity for Bitcoin lags by about 3 months, while gold reacts immediately. The reason? Gold reflects direct fear of currency devaluation, while crypto is more dependent on systemic liquidity flows. At the same time, record deficits, manipulated markets, and complex monetary policy are driving structural changes. This isn't a short-term hype, but rather a fundamental shift in thinking. So the question is not whether a new bull cycle is coming, but only when this explosive phase, this banana zone, will actually arrive. The conditions are favorable. Liquidity is rising, sentiment is cautiously optimistic, and many investors are still underinvested or watching from the sidelines. As in the past, according to Raoul Pal, these combinations could quickly trigger price movements even before the general public reacts. While institutions are quietly setting the course in the background, private investors have little time left to avoid missing out.